The S&P 500 is on the brink of reaching the 5,000 mark for the first time. Robust economic data and upbeat earnings have lifted spirits on Wall Street, despite uncertainty about the timing of the Fed's rate cuts. So how should investors be looking at their portfolios? Here to discuss, let's bring in Burns McKinney, NFJ Investment Group Managing Director, Senior Portfolio Manager, to this conversation. It's good to talk to you this morning. Let's start by talking about earnings, because that does seem to be the big driver, or at least today, when you think about the big names like Disney really surging ahead. More than 80% of S&P 500 companies that have reported earnings reporting beats. What have we seen in terms of the outlook that suggests that momentum can continue?
One of the things that's been interesting about this earnings season has been that stocks have reacted somewhat favorably on both the upside as well as less unfavorably on the downside than one might have expected, particularly given how rich the market is. Typically, when markets are, kind of reaching a high level, and in which too much optimism is baked in, then you would expect to see stocks react a bit more negatively to negative earnings. We haven't seen that so much this period. That said, I think that's probably, if anything, the dynamic that's continuing. It's that the market isn't necessarily responding as much to the fundamentals or earnings as it typically is. I think if you just you look on a day-to-day basis, we're continuing to see the same dynamic that we had in 2023. And that's that on a daily, weekly, monthly basis, the key driver for equity markets overall has been what interest rates have done. When you had in the fourth quarter, the Fed pivoted and suggested that, okay, we will be perhaps lowering rates next year. That's what led to that everything rally that really, for all intents and purposes, I think one of the ways we kind of put it is that the market had a great 2024 during the fourth quarter of 23. And to some degree, I think a lot of that dynamic is overwhelming the individual company by company earnings impact.
So then, Burns, what do you think is going to define the current state that we're in? We have markets sort of essentially in a holding pattern, waiting for these rate cuts. The Fed also in its holding pattern as well. What are the picks then that you would advise?
Well, if we look at the market overall, you can't argue that stocks are cheap. I mean, right now the S&P 500 is trading at 22 times earnings. It's more expensive than it's been, 3/4 of the time over the last 25 years. That said, the old dictum is it's not a stock market; it's a market of stocks. And so, there definitely are opportunities for investors. And the other dynamic that we've seen really ever since the Fed pivot is that seems to have kicked off a situation whereby you've increased the breadth of the market. And after you saw that Magnificent Seven really lead equities for all of 2023, you're starting to see a bit of a broadening, whereby a lot of the areas that were laggards last year have started to maybe make a little bit of a breakout moves. Areas that didn't do as well last year, things like real estate, things like utilities, even some of the banks. And so what we're advising investors is to build a portfolio of quality names. And likewise, because inflation sometimes does have a second wave, and in case it does make a comeback, one of the best ways to combat that is companies that are both paying and raising dividends is a great place to be in this type of market.
So Burns, let's talk strategy, specifically on the sectors that you're liking right now, industrials and healthcare. What do you see there, and what are the big names that you think investors should be watching?
Well, in the case of industrials, you have some longer term secular trends. For one, we're really seeing in the U.S. a rebuilding of our industrial base. That spending has lagged for many years, and with onshoring, I think that's another driver of that. And probably one of the biggest drivers would be the infrastructure bills that were passed. I understand that was really more in the news 2 or 3 years ago, but a lot of those dollars are just starting to go out the door now and aren't expected to peak until 2026. And so investors have that in their favor, and a circumstance where valuations aren't terribly demanding. And on the flip side, healthcare, especially in a market when we really are saddled with uncertainty, healthcare is the one sector that kind of allows investors to kind of put one foot in one area and one foot in another. Specifically, it's an area that investors can play defense, given that stocks are somewhat rich. You do have positive long-term demographics, but you can also play offense. That's the sector for which going back over the last several decades, where you've seen the best earnings growth, even faster than the growth you've seen in tech. And so, yeah, you really get kind of the best of all worlds with the healthcare sector.
And Burns, I want to ask you about the potential for how you weigh a wage price spiral, because one of the things that came up in Treasury Secretary Yellen's testimony was you're seeing wages continue to go up, but you're also seeing inflation sort of holding steady, but the core indicator at that 2% rate that the Fed is looking at. So what do you do with that in terms of how you're planning to navigate this if this does continue for a prolonged period of time, this higher for longer?
When you think of wage price cycles, one of the most important dynamics that investors should look at is investor expectations and market expectations. And one of the things that does have us feel a little bit more sanguine, or maybe a slightly less concerned with that, is the fact that investor expectation, because you can result in that self-generating cycle, but throughout the inflation wave that we've seen over the last couple of years, investor expectations have remained somewhat in check, and in fact, over the last several months, those have in fact pulled down a little bit. And so, that's one thing that helps. The other factor being, I think that maybe pushes the other direction would be that the jobs market is still tight. The Fed is, it seems to have threaded the needle between not necessarily cutting jobs, but job openings, which might actually give a little bit of cushion. But nonetheless, I mean, when the Fed started their tightening cycle, unemployment was 3.6%. Today it's 3.7%. With even though there's a lag, that's kind of accounted for. And so the job market remains strong. I think that's one reason why the Fed is really concerned about repeating some of the mistakes that central bankers made in the 1970s. And that's probably, if anything, that investors can take from what I'm saying there is that they're probably going to err on the side of not cutting rates too soon, and just really not take any chances of losing any long-earned credibility.
Indeed, that fear of reacceleration of inflation still heavy on the Fed there, indeed. Appreciate you taking the time to join us this morning. Burns McKinney, NFJ Investment Group Managing Director, Senior Portfolio Manager. Thank you so much.